Hello everyone, and thank you for joining in to the webinar. Today we are going to talk about decoding trends with RSI and Fibonacci. To give a brief introduction about myself, I'm Dhwani Patel. I'm a trader and trainer with Market Feds. And to give a brief about the company, so Market Feds Analytics LLP is formed with an objective of practical implementation of strategies with theoretical insights. We offer various courses on financial markets and coaching for professional courses like CFA and CMT. Our major courses are mainly on technical analysis, where we provide 3 levels into it: basic, intermediate, and advanced, and a mentorship program where you start your journey from learning to becoming a trader. We even take care of forex trading through technical analysis. Apart from our main courses, we have special weekend courses as well, where we cater to specific topics like candlesticks charting with psychology, edging with RSI and MFI, Fibonacci and harmonic patterns, bar chart patterns, and with the changing dynamics of the investments and technical analysis, we even cater to statistical implementation and backtesting of your strategies. To tell something about me, I am a trader from last 9+ years. I mainly trade into equity markets, and from in equity markets, I trade into instruments from cash to options and futures as well. Now, let us begin with the topic for the day. So, the topics that we are going to cover today are basically what is a trend, what are your momentums and oscillators, a brief introduction to RSI, how do you analyze the RSI, then a brief introduction to Fibonacci, what are the Fibonacci tools that we have, and how do we combine these two to take up a profitable trade position, and at last we'll be taking up question and answer sessions. Now, what is a trend? Trend, in very simple terms, if we define in a layman language, is the direction in which market is moving. So we have 3 kinds of trends, which is a bullish trend, a bearish trend, and a consolidated trend. Bullish trend is when prices are moving and making higher high and higher lows. Bearish trend is when we move, the prices are moving down, making lower high and lower lows. Consolidation is nothing but your sideways trend. Now, sideways trend, here we have put it into a definition where we have an approximation of 5%, maximum 5% move from the high to the low, which is what we call the resistance, to the support level. And it is extended from a period of 2 to 3 weeks to months. We'll be taking up an example for the same through the software. What do we see here? This is a downtrend. We are making lower lows and lower highs, and an uptrend over here. And this is what we call the consolidation phase, right? Where we see that over here we have a level from which we entered into the phase, and after breakout we took again a support over here and moving up again, right? Even we see over here earlier the same level has been followed. Now let's move down to what is a momentum and an oscillator. Your momentum is, first of all, not the volatility. By volatility, we mean the daily price movement which is there, or the fluctuation which is there. But momentum is the difference between two prices which we take over a fixed interval of time. Let us understand by a small example. We have taken prices at 4 days. So here when we talk about the change of price from day 1 to day 2 has been 5 rupees, wherein if we talk about the momentum of the change in price over a period of 4 days is 0, as the price after day 1 and day 4 is the same. So by momentum, we define the change in price over the fixed interval. Momentum defines the speed of change in price, that is the sentiment of the buyer and seller. So we can say here that even after 4 days, the sentiment of the buyer or the seller has not changed. It is still valuing the stock at the same price. So now higher the speed of change or steeper the angle, lesser are the chances of it reverting back to the trend line, which we see over here in Nifty, wherein we had a very big candle forming over here, which we generally called it up as the Nirmala candle. After the prices broke above this level, they never went below it again, right? So now we'll understand what is an oscillator. Now momentum could be a very wide category. It does not have a bound range. So when we bind this momentum of prices over a period of time, we put them down into oscillators. Then oscillator is the representation of momentum line fluctuating above or below the zero line, or defined as a range from 0 to 100 or 0 to 1 or anything, but it has a defined range. So basically we are normalizing this fluctuation of prices into a defined range so that we can have better analysis of the same. Now today we are going to concentrate and learn about a very prominently used oscillator, which is the RSI, that is the relative strength index. So by relative strength, the per se perception of people goes into that it defines the relative strength in comparison to the market or a stock, which is wrong, which is not the case. Relative strength here means that we are measuring a securities or a stock or any price that we have, be it stock or commodity or anything. We are measuring that price strength relative to its own price history and not in relation to any other factor. So to tell a brief about what is the background of RSI, so we'll get a little into the formulas. RSI was developed by Wills Wilder and it scales between 0 to 100. So the formula goes like RSI is equal to 100 and RS plus 1 divided by 1 plus RS. So your RS is nothing but your upward price changes during N days. And your AD is your downward changes in price. To understand this thing better, when we are talking about the upward changes during a particular number of days is, we already saw that RSI is nothing but changes over its own price history. So we are relatively comparing that in the past few days, what has happened with the price of the security. So here, when we are talking about the upward changes during end days and downward changes, so we are comparing n minus, let's say, 14 number of days before. So what is happening since last 14 days with the price? And here we are using 14 for the reason being it defines your cycle for half of the month, right? Now, let's see how we put RSI into our charts. So over here, I have taken the chart for Nifty, right? As we see, there are too many whipsaws. When you even put a line chart, there are too many whipsaws that we see. To smoothen the price, we use a moving average into the same. So over here, I am applying an average and smoothening the value of price. So we always take an exponential moving average. Now, just a small brief as to why do we use an exponential and not a simple moving average is when we're talking about a simple moving average, it takes into consideration only that many number of days and leaves the last number when we are moving on to the another set of data. So when we are taking suppose say 10 days over here, what it would do is in a simple moving average that it would drop off the 10th, the day before the 10th day and take the next day. So we will have a drop off effect. If there has been a major volatility in that particular day, we would not be able to account it in our uh, pricing right now, in our average right now. So we take an exponential moving average, which which is free from the drop off effect that we have. Here I am taking a exponential moving average of 5. We change the color for a better presentation so we can easily spot it. Now, if we see over here, see how the price fluctuations have smoothened out. We do not have too many price fluctuations happening over here. Now we would put in the RSI. Currently, I am not changing anything into the parameters of RSI. I am just keeping it as it is, which is we are taking the 14 and 9 exponential RSI and using the input as the price close. You see over here. So over here, what we see is that again, when we see the RSI, there is too much of fluctuation happening over here, right? Too many crossovers happening. So to avoid these crossovers, what we do is, again, I'm adding the RSI, but input, again, this time I'm changing it to a smoothened moving average. And here, we do not have too many crossovers happening. So the more smoothened data you take in, the lesser would be the crossovers and would be better to judge as to which system is working better for the stock that you are taking into consideration. Right? So that is why how do we add RSI into the software and why do we take a smoothened RSI as compared to a normal RSI? Now, let's move on to a very important thing as to how do we analyze the RSI. So there are 4 different ways in which you can analyze and interpret the RSI. The first one being the divergence, then the trend determination, patterns and trend lines, and an overbought and an oversold zone. Now let us first talk about the overbought and the oversold zone, because as soon as you add RSI into your charts, you see two dotted lines on the top and the bottom, which make me very curious as to what are these. These are the overbought and the oversold zones of your RSI. The most basic and the very first thing we look onto a chart when we see RSI is the overbought and the oversold zone. Overbought zone and oversold zones are defined traditionally by 70 and 30. So when we see over here, the top line over here, this is 70 and the bottom line is the 30. Your overbought zone is typically when a stock has been in a trending upwards for a longer phase, and help us understand that profit taking is round the corner. How do we understand that? Now over here, if we see that the RSI has given us a crossover and it is moving upwards, right? After this, if we see over here, right, we get a negative crossover and it went down. So profit taking has happened over here. Right? Every time the RSI has been given a crossover from the bottom and moved up, we see profit taking happening. So this is typically your overbought zone and this is your oversold zone. And your oversold zone is when a stock has been trending downwards for a longer phase of time and a short covering is due. In trending stocks, it is not necessary that when RSI reaches 70, it must be sold for a reversal. Likewise, what we saw over here, currently I'm taking only Nifty for the explanation purpose, but we will be getting into stock specific explanations as well. So over here, what we see is that the RSI entered the overbought zone at this level, which is 11,500. But after that, we saw it still moving upwards to 11,800 levels. So that 300 points, if you had blindly sold after it entering 70, the 300 point upward movement would have wiped out your account. Right? Is so far so good for everybody? Is there anything you want me to go back and take care of? Please raise your hand and put it down, or else we could go ahead with the further explanation. All right, looks like so far so good for everyone. Now, again, so what do we do when we see such a thing that 70 is not your overbought or your oversold zone? We modify the range of RSI. So whenever there is an upward trending stock, we modify the range of RSI, the upper limit from 70 to 90 and the lower limit from 30 to 40. And similarly is the case in a downward trend. The range is modified from 60 to 10. Now, how do we put it over here? So this is one system which I follow, wherein I have added multiple moving averages and divergences. So what are we going to do over here is we are going to add RSI with the other two parameters of range that I have told you. Which we get them over here. See over here. So this range we will be modifying. We'll be putting it up as 60 and 40, and we even have defined this as 90 and 10. And the input we are going to take it up as 5. Right? So now what happens over here? We get another 2 lines into the RSI added over at this level. Right? Now how does this help us in analyzing? We'll be seeing now. I would first be taking trend determination, then we'll move on to divergences. So RSI is even again useful for your trend determination on a monthly chart, and currently we'll be checking on a weekly chart. When RSI moves above the defined upper and lower range, the stock is said to have entered the uptrend or the downtrend. Their threshold vary marginally for stocks, but mostly upper ranges from 60 to 65 is what we have observed, and the lower is from 40 to 45. When the RSI is between the defined range, which is 60 to 40, we see that the stock is in a consolidated pattern here. Now, can we have any stocks which you would like to check this thing on? So I would take an example of, let's say, Axis Bank, right? And from daily, we are moving down to a weekly chart. I would just wanted to observe the RSI, which is at the bottom of the screen, where we have added the other two threshold levels. What do we see over here at this point in time? The RSI is between the 60 to 40 range over here, right? Now, what do you see? The price is in a consolidated pattern at that point in time. It is neither trending upwards nor downwards, right? As soon as the RSI crossed 60 over here, at this point in time, we saw some spike happening. But again, it fizzed out and it entered into this range pattern, right? But as soon as the RSI went up from 60 over here and didn't return back into this pattern, what do we see? The stock has been trending upwards, right? Now we'll check on SBIN. Again, what do we see over here? The stock has been, moving above and below this range, but not trending. See over here, when we see it is in a range over here, and now currently it is moving again back to the 60-40 level. We even have another request of, right. Again, if we observe this chart properly, we see the trend has turned downwards, right? Went below the 40 levels. See? Now currently in this stock, if there's a crossover happening over here, I hope everybody is aware about the golden crossover and the death crossover, right? When your 50-day is cutting above, it's a golden crossover, and when it is cutting below the 200 moving average, it is your death crossover. So here what we observe is that a crossover is pending due. Now, once we have seen on a weekly that the stock is in a downtrend, what we do is we do not trade in a buy zone for that particular stock. We always look for an opportunity to sell it. So whenever a stock is moving above 60, look for an opportunity to buy into the same. And when moving below 40, look for an opportunity to sell. Do not counter trade against the trend over here. If you are a swing player, we will be getting into how do you counter trade against the trend with the help of retracements in the later part of the session. But currently we are just doing a trend determination as to we are going positive or on the downside. So currently what we can see is that PEL is in a downtrend. Now, so this is what we do by trend determination. Now let's go on to divergences. The other way of analyzing RSI is by way of divergence. Divergence is when price and oscillator do not conform. It is when your prices are moving up but your oscillator is not, or else your prices are moving down but your oscillator is moving up. So where we talk about two types of divergences over here. One is the positive and the negative, which is your bullish and your bearish divergence. Your bullish divergence is when your prices are moving lower, but your RSI is making a higher high than the previous high. Right? Let's take up an example over here. If we can spot a bullish divergence. Nifty. So what I have observed, this is for day traders who want to earn intraday money very quickly. When you put these divergences as a study on a I5-minute chart, we have much better results in Nifty. So we see a bullish divergence which happened over here in Nifty on 6th, and we take a position over here in the next candle, keeping the current candle low as your stop loss. You buy into the same, keep trailing and see where it went. So this is how divergences work on I5 on Nifty, right? This is an inbuilt study by Spider Softwares, which you could get it done. Again, we had a bullish divergence over here at this point in time, right? And from 11,850 levels, it went up to 12,000 levels. So that's almost 150 points of a move, which one would have gauged into. Similarly, let's look at negative divergence. Your negative divergence, it occurs when prices are moving higher, but the RSI is making a low lower than the previous low, which again we see over here, right? There is a negative divergence and it went down. And you could have easily booked in your profits over here, seeing a positive divergence and taken a counter trade against the trend. So far, so good for everybody. All right, we'll take a couple of other examples for divergence as well, wherein one of my favorite, which helped me make good amount of money, was Dr. Reddy. On a daily chart, there was a divergence happening over here. If you see, the prices made a new high over here, right? But my RSI did not confirm with it. After that, you can see what happened to it. Now, how do we, so these are certain features by Spider. Now, how do you make your own divergences? So, a positive divergence is made connecting the bottom of the price. So, you connect the lows to the lows of your prices and you connect the lows of your indicator and you make a positive divergence. So, here your RSI is falling, your prices are falling, but your RSI is making a higher high, right? What does this imply is that the strength in the prices is not falling with the fall that you see actually in the prices, because we are comparing n period of prices prior, the momentum what we talked about in the very starting of the session. And when you're making a negative divergence, you connect the tops of the prices and the tops of your RSI and make up a negative divergence. Currently, we are seeing a positive divergence happening over here in AB Capital, right? See, and look at the price. So how do you trade with these divergences? That once you have spotted your divergence at a particular candle top, we're talking about the negative divergence first. So when you see a divergence happening, you sell at the next candle after the close of your current candle, right? Over here. What do we do over here is we saw a divergence happening over here. This is the next candle where you make your sell trade and keep the high of this candle as your stop loss and trail it. When would you book in the profits for this particular stock, right? First, looking at only the RSI as a factor, you can book in over here when you spot that there is a change in the RSI. So when you have, once you have made a sell over here, right, at 100, and the change happened over here at this point in time, right? So you booked in your profits at this level, which is 86, which is a 15 point move. And similarly, when we are doing a buy trade with a positive divergence, which we see again in this stock. Meanwhile, I explain this one. If there are any particular stock requests where you want to check in about the divergences, please put forward. We would check into those as well. Right. So getting back to the positive divergence, how you trade those. So this is where your lower low happened, but your RSI did not confirm with it. You take a buy trade over here in the next candle and then you trail it. Now this particular trade I would exit when the RSI is giving me a negative crossover. Till that time I would trail this particular stock. So Now we have seen three ways of how do we analyze the RSI. One is your divergence, second one being your overbought and oversold zones, and the third one being your trend determination. Let's move down to the fourth one, which is nothing but your patterns and trend lines. Yes, you can even analyze RSI as you are analyzing the price, because ultimately, as we saw earlier, your RSI is nothing but the representation of your prices, the momentum of your prices over any period of time. So if you are applying a pattern or a trend line breakout to the RSI, to the prices, the similar thing you can apply to your RSIs as well. And a simultaneous breakout in both would give you wonderful results. So in RSIs also you can find out trend line breakouts, triangle formations. At times we have even noticed a head and shoulder formation into the same, right? Let us take up some example for a RSI pattern. Over here itself, if we see in Adani ports, I'm taking the top from the RSI, joining it to the other top, and I get a breakout over here. At the breakout level, we are even entering from the oversold zone to the consolidation and then the overbought zone. So if I check the breakout at this point in time, right, see what has happened over here. We took the entry, right, and then the price move after that. All right, looks so far so good for everybody. Now let's move down to Fibonacci. So what is your Fibonacci? It is as simple as 1, 2, and 3. I'm not joking. Fibonacci numbers start from 1, 1, 2, and 3. So Fibonacci is nothing but a sequence or series of numbers which start in the following manner, where we add the previous two numbers and give a third number. So it starts from 0. 0 and 1 make a 1. 1 and 2 make a 3. 3 and 5 make an 8, and so on and so forth. And Fibonacci was given by an Italian mathematician from Republic of Pisa. His name was Fibonacci, and that is how we have the name. You can find Fibonacci everywhere, from nature to human life. And currently, a very good example of Fibonacci came to me in the man-made object also, which was the Jyotirlingas of Shiva in India, wherein they are arranged in the Fibonacci spiral over here. It's an amazing number. How do we put everything in place with the same thing? So if it works so much into the nature, why would the numbers not work for technicals? Definitely would, right? So we tried implying the same into the tools, and we have 4 tools through which we can find out the price movement. First of all, before we get into the tools, I would want you to understand two concepts, which is the retracement and the extension. So what do you mean by a retracement? Retracements are defined as moves against the existing trend. So if we are in an uptrend and have a move against the existing trend, which we call as profit taking or short covering, are known as retracements. Extension is the continuation of an existing trend after a counter move, right? Once you have understood these two concepts, I would let you know the Fibonacci levels which we would take. These are the percentages which we take in the Fibonacci: 23.6, 38.2, 50, 61, 76.4, 100, and so on. 38.2, 50, and 61.8 are the important Fibonacci levels. I would show you an example and you will be astonished to know that they work so well. So before we get into the examples, now let us understand why we need to combine these two systems. Now, what does RSI tell us about the strength of the market? Whereas adding Fibonacci to this help us understand and find the important levels of trading those signals. First, we spot a trend formation or a trend reversal based on the trending method which we checked for RSI. Then we would use Fibonacci price extension or retracement tools to find the next possible price level. Let us get into the example now. I've taken an example of Hevels being one of the stocks which again helped me earn good amount based on these indicators. We saw after the consolidation a downward trend and a reversal which has happened. So we knew about the trend, that a downward trend is into place. Now, based on only Fibonacci, we will not be able to understand as to when is the reversal coming in. We add RSI to the same. In this, you will be able to see. Earlier, I had not added in RSI. Now I have put in RSI into this thing. What do we see over here? There was a downward trend, right? The RSI went below the zone and gave a crossover at this price, after which the prices started moving upwards. And when it entered into the Fibonacci level, I take my position at this time, right? And see how it has. So this is my 23, 38, 50, 61 and 73%. How it stopped at this particular price and reversed from there. And again moving upwards, it has moved till 50%. Let's see how it reacted today to our Fibonacci. Wow, surprising, right? It reversed exactly back from 50%. Similarly, I would take a detailed case of one more stock. Okay. So there's some already work being done. We will just make that thing vanish first. Now, pretty simple, right? Now let us understand what is the stock into. It's moving upwards. It's moving upwards from this particular price level, right? Over here, we had divided the RSI into 4 zones. From this level, it started moving up. When it crossed 40, consolidation zone, which we again see. If you are able to see the consolidation zone happening. When I talked about patterns, if you see a pattern also happening here, the bottom chart RSI, if you see, it is making a triangular pattern over here, right? I would just draw it up and show it to you. Once I have drawn, I would zoom into the area for better visibility, right? Yeah, see over here. It's making higher lows, and here it is. So it's making a descending triangle. It was into a consolidation phase till this particular time, and once it moved above the 60 level, the stock went into a trending zone. Again, it did not cross above 90, so it was not into a uptrend after that. It give you a good chance to exit at this point in time, and went back down. Again, crossing above the two zones, it moved till here. Now, how do we make use of the extensions into this? We'll quickly get into that. The stock is in an uptrend. First of all, let us see how we will gauge, this counter trend, as people would be interested in. I mean, why do only one side trade? We even want to have, both the trades. So over here, we put in retracements. We take price retracements. I've put in the percentages already. And so this is a very nice feature which I like in this software, is that I do not have to search for the highest high or the lows. I just need to press an L for the lowest low and a H for the highest high, and my work is done. Now, what do we see over here? The prices from this level, they retraced back, right? We got a negative crossover at this point in time. So first, what we saw in the RSI is the prices did not move above the 60 level that we had, right? It gave a negative cross from there. When we make so we add a retracement to it. How much is the price going to retrace back now? So this is my 23%, my 38, 50, and 61, and so forth. Exactly at 72%, the prices stopped here and started moving up back again. How beautiful it works, right? So technicals, there is one thing. Keep it simple. The simpler it is, the better results it will give you. Now, after this, I get a positive cross. I've booked in my profits at this level. I get a positive crossover. I don't know what are going to be my targets. I just buy into it. But at one point in time, I need to book them, right? So what do we make use of? We make use of price extensions. How do we draw that? Again, we connect the low of the previous up move to the high, and then again to the low of the retracement. See, it did not move more than, it just did not move to 100% of my previous up move. It moved way above it, right? So once you reach to this level, what you do is you trail your stop loss, right? And then keep trailing above as it goes. And as you see that each time, it is touching the threshold, it is giving a one down day move over here, right? Each time we move to a threshold, we have a one down day move over here, one. Once we cross this threshold, one down day move into the phase. Again, cross the threshold, again moving into this. So these are the important Fibonacci levels which work well into this stage. Once we have moved above this, See, it's there over here, right? I guess I have made it clear. In case if there is any particular doubts, you can just let us know. We'll take certain questions now. All right, we have one question wherein the person wants to know if we have a divergence on TEL weekly chart. I wouldn't say that. We do not have any particular divergence on a weekly chart. The prices have moved lower. Again, what do we do here is that this is a lower low. RSI, we have defined a range to it, right? We have a defined range to it from 0 to 100. When we're talking about a lower low, you have to be very vigilant when you're checking the same. Over here, we see a low which has gone close to 19 range, right? Not lower than that, 18. And here we have got a range which is lower than that, which has gone to 17. So it justifies that the low has been maintained. It is a lower low. So that is where the trick is, that you have to be very vigilant in terms of those, right? All right. So we would conclude the session over here. And thank you everyone for attending the same. You could find us on our social media handles, Facebook, Twitter, and Telegram. We have our Telegram channel as well. And you could drop in a mail in case of any queries or contact us on the number provided. Thank you.